Hello again. In this video, we'll walk through a simple problem involving some of the expenses related to automobiles incurred by small business owners. Unlike employees who are extremely limited in terms of their automobile expense deductions, sole proprietors earning business income have increased deductions available to reduce their income. Effectively, all of the operating costs, like fuel or repairs or insurance, stuff like that, that should all be deductible from business income, the business portion, that is. However, there are some limitations. Now we're going to talk about those. So irrespective of the purchase price of an automobile, a passenger vehicle, the amount that is available for deduction over the course of time for a business car, a company car, is limited to $30,000 plus applicable sales taxes, which means if you go out and buy, I don't know, a $90,000 Tesla for your business, that's fine. You can drive it around and use it for business purposes, but the maximum deduction that you're going to be able to take over time is $30,000. Now, the maximum lease payments that are deductible on a monthly basis is $800. So again, even if you're leasing a car and it's $1,400 a month to lease the car, the maximum amount on a monthly basis that can be deducted from income, $800. Maximum interest on a car loan is defined as the lesser of two things. So this is if you go to the bank to borrow some money to purchase a car for business purposes, the interest payments that are made have a maximum amount that you can deduct. So it's the lesser of two things, and the Income Tax Act frequently does this where they'll say, oh, well, you can have the lesser of two numbers, and then you have to determine both numbers. So the first number that you're going to look at is the actual interest costs, and then you're also going to calculate out $10 per day that the interest was payable in the year. Basically, how many days in the year was the loan outstanding? Did you pay interest during that time? So determine how many days in the year the interest was payable, multiply that by 10. Compare that to the actual interest costs. The lesser of those two numbers is going to be the one that you're allowed to deduct. Now, I guess this goes without saying, but it probably doesn't go without saying. Only the business-related portion of any of these expenses related to the automobile can be deducted. Any personal use portion of the car is not allowed to be deducted, so you have to prorate all of these expenses for a business use portion. Okay, let's take a quick look at the fact pattern here for Chapter 5 Worksheet Exercise 2 that deals with auto expenses. So this is straight off this week's worksheet, so you might want to print that out and follow along. So here we have Bowman Recycling. It's a sole proprietorship and it's owned by Craig Bowman. We're dealing entirely with sole proprietorships and not corporations here. These are small owner-managed businesses. On January 1st of the current year, Craig leases a new Lexus. The lease calls for monthly payments of $1,400 per month, payable on the first day of each month for a period of 4 years. The manufacturer's list price for the vehicle is $66,000, so that's how much it costs. During the year, he drives the car for a total of 32,000 kilometers, of which 15,000 relate to the business, meaning what? 17,000 must be personal use. Okay. So he's driving the car more for personal than for business. What we're required to do is three things here. The first one is we're going to determine the maximum deduction for the lease payments that he can deduct. Then we're going to take a look at what happens if Craig purchases the car for the manufacturer's list price and borrows money. We're going to figure out what his interest deductions are going to be. And then thirdly, we'll take a look at the question from the perspective of one of Craig's employees for the year. We're going to determine what his taxable benefit is. Remember, that's standby and operating costs, and we're given the appropriate rate. All right, let's do it. Okay, let's start with Part A, determining the maximum lease deduction. So the maximum lease deduction in any given month is $800. We know that this guy's paying, I think, $1,500 a month, so we're going to have to be limited to $800. $800 per month. We're going to times that by 12 months because we know he got this car on the 1st of January. And then, this is the important part, we have to remember to prorate. Only 15,000 out of the 32,000 kilometers are for business purposes. So that's the extent of the deduction we can take. We're going to multiply that out, and I believe it's $4,500. All right, let's take a look at Part B now, which states that independent of Part A, so ignore what happened there, assume that rather than leasing the car, Craig purchases the car for a manufacturer's list price. I think that was $66,000. He borrows the money from a bank and pays interest at 6% a year. Payments are due annually at the beginning of the year. We can ignore GST and PST. All right, so we need to determine what the maximum interest deductions are, and we know that there's a limitation here, and it's limited to the lesser of two things. So it's going to be the lesser of 1, the actual interest costs paid in the year. So how do we come up with that? Well, $66,000 is the amount that the car was borrowed for. The interest rate is 6%. We don't need to prorate for the amount of time in the year because this guy bought the car in the first day of the first month of the year. So 365 days, no prorating necessary. What we do have to prorate for is the business use of the car. This guy used the car for business 15,000 kilometers out of the total 32,000 kilometers. So if we multiply this out, it's 1,856. Okay, that's great, but we have to look at the lesser of two things, right? So this is one number, and we're going to come up with the second number here, and that is $10 a day times the number of days the interest was actually payable. Because the loan was outstanding for the entire year, 365 days, we'll do $10 per day times 365 days. But again, we have to prorate this because of all that driving he did, only 15,000 kilometers were business use. So if we multiply that out, we get 1,711. Note, of course, that the formula says we must choose the lesser of the two numbers. And the lesser in this case is 1,711, $, underline. So that's the deduction that Craig is limited to. Let's take a look for fun at this question from the perspective of the employee. So what if instead of using this car himself, Craig allows one of his employees to use the car? That means you've got an employer-provided automobile as an employee, and we need to quantify what the taxable benefit is to that employee. So everyone should be pretty comfortable with this by this point, but this should be a fun little trip down, memory lane. We'll consider what type of standby charge we're calculating, and we know that the vehicle is leased. So our standby is going to be 2/3 times the number of months, and we'll assume that's 12 times whatever the monthly lease costs are, which are provided in the narrative. We know that the vehicle is used more personally than for business, so we cannot apply any kind of standby charge reduction, which makes the question a little bit easier. So let's just go through the math. Standby charge is 2/3 times 12 times 1,400, which are the monthly leased costs. So we got 11,200. We've got an operating cost benefit here calculated by multiplying the current year prescribed rate times the number of personal use kilometers. If 15,000 kilometers are used for business, and we have a total of 32,000 kilometers, and we know we must have 17,000 personal use kilometers, and we just total those up for the total taxable benefit shown here. That's it for this one, guys. Try the problem out for yourself and read through the detailed solution on D2L. Best company car ever.